Welcome back. Let's take a look at the latest on Capitol Hill. Christmas just 2 weeks away. Lawmakers are eager to move the tax reform bill along. Heavy hitters on Wall Street, including J.P. Morgan and Citigroup, have rallied on news of progress with this bill. Many view the banks as one of the clearest beneficiaries of this tax reform bill. I want to bring in research and bank analyst at Vertical Group, Dick Bove. Dick, good to see you. Thanks so much for joining us.
Thank you, Maria.
So I know that you have an important report out on Fannie Mae and Freddie Mac, the government-sponsored entities, and the impact there. So let's get to that in a second. First, though, broadly speaking, what is the tax reform implication for the financial services sector in your view?
Well, it's extraordinarily positive because the average bank in the United States pays a tax rate of 31%. And if they cut it to 20 or 22%, if you do the math, it immediately jumps the earnings of the banks up by 16 to 18%. So it would suggest that these stocks are relatively cheap.
Okay, so the banks, then, you've got basically the banks going to see 16 to 18% earnings growth just on the tax plan?
Yeah, in other words, it's simple math. In other words, if you're paying 31%, let's say you're paying $31 on every $100 of earnings that you have, and it now drops to $20 on every $100 of earnings that you have, you've made a profit of $11 simply because of the tax cut. If you divide the $11 by the $31, you've got a nice 16 to 18% increase in your earnings simply because of the tax cut. And there are other benefits that will come in, because there are certain tax benefits which this bill still allows the banks to have, like on low-income multifamily housing. So the tax bill is wonderful for the banking industry.
Dick, the Senate version of this bill has a provision called first in, first out, where individuals who sell stocks have to sell their oldest stocks first, which could cause big capital gains hits for them. Financial institutions who do this, mutual funds, for instance, don't have to go by that same first in, first out provision. Is that fair that big financial institutions don't have to follow this provision that's going to hurt individual investors?
Depends on whether you're invested in them or not. In other words, from my perspective, rather than getting involved in the morality of the bill, I'm just looking at what the bill says. In the instance of these large financial institutions, everything has moved in their favor. In other words, in the last 12 months, they've changed the leadership of the Financial Stability Oversight Council, and 8 of the 10 people who are directors there will change. You got a new leader at the Fed. 5 of the 7 chairs there will change. New leader at the FDIC, new leader at the OCC, new leader at the NCOA. You've got 2 out of the 3 people at the CFTC changing. New leader at the CFPB.
Wow.
New leader coming in at the FHFA. You have done, for the first time ever, changed every one of the leaders of every one of the bank regulatory industries, bank regulatory agencies in the United States, and that's going to be really, really good for the banks.
Dick, if you take out the private activity bonds, which you have in one version, does this hurt significantly the infrastructure bill that the president wants to get passed?
Well, I'm not an expert on the bill. I've read the Senate version, I've read the House version, and it's very hard for me to project, what is ultimately going to be the rate that the banks pay on what they do, and I'm not sure that I can answer that question.
What about the Fannie Mae report that you just wrote? Dick, you say that the GOP tax reform bill will force Fannie Mae and Freddie Mac to seek money from the Treasury after wiping out their equity. Explain this, please.
Well, first off, Fannie Mae and Freddie Mac are companies which have no equity, right? In other words, if we just take Fannie Mae alone, their common equity is negative $132 billion. If we look at their total equity, and if we were to do the proper accounting, their equity is negative $9 billion. All right, if we do the tax cut, which reduces the value of the deferred tax asset, that'll throw another $10 billion of negative equity onto Fannie Mae. So now you've got $19 billion in negative equity. In 2 weeks from now, Fannie Mae is supposed to hand over all of its capital to the U.S. Treasury, which my belief is they're going to refuse to do, which is going to create somewhat of a conflict between the Treasury and the FHFA. So, we go into the beginning of next year with a possibility that this entity, which has no equity, which has got negative equity, is guaranteeing $3.2 trillion worth of mortgages in the United States. It's a farce. It's ridiculous. And, you know, in my view, Congress, you know, which has kept its nose out of this thing for the last few years, has got to come back in, and something has to happen here.
Dick, isn't the equity the full faith and credit of the United States government? I mean, it's not like these companies are going to stop guaranteeing mortgage bonds because they've got the U.S. Treasury behind them. I mean, do they even need equity in a situation like this?
They don't have the full faith and credit of the United States government behind them. That is an assumption that the market makes, which is totally incorrect. There is no guarantee from the United States government that it will back any of the debt of either one of the GSEs.
But it did. We had a financial crisis in 07 to 09, and they got bailed out by the United States government. I mean, the proof is in the pudding, isn't it?
Yeah, well, the assumption is there. But the full faith and credit of the United States government is definitely not there. It is not there. And that raises a different issue, which is these are not legal investments. These are mortgage-backed security companies. And therefore, there's a whole bunch of institutions which are required to buy legally backed investments that own these things that shouldn't be allowed to own them. And they can be sued for doing so if, in fact, the Congress says, we don't want to make sure that these bonds are okay.
And the shareholders are upset because under the Obama administration, they took money from other places in the government. They took money from Fannie and Freddie, and they used it for other places in the government, which Stephen Mnuchin has confirmed.
Yeah, well, no, there's no doubt about the fact that that's true. I mean, even the highway bill takes money from Fannie and Freddie. But what is most, important is that, the Trump administration has this thing on a silver platter that they can hand to the Democrats and embarrass the heck out of them, because basically, back, in 2012, there was a report handed to the Treasury saying these companies are going to be profitable forever. And the Treasury immediately went out to the public and said, we need to take over these companies because they're losing money.
Right.
They lied. They blatantly lied to the public.
Wow, that's incredible. Dick, thanks so much. We'll be watching the developments here. Great report.
Thank you.
Dick Bove joining us there.